Hi everyone, this is Taylor with the Daily Gettin, and this week we're going to talk about Title II of the CARES Act. That's the Coronavirus Aid, Relief, and Economic Security Act. Title II is called Assistance for American Workers, Families, and Businesses. It's split into 3 sections. We'll go into each section in detail so that we know exactly what's going on, and as always, it'll be straight facts, straight from the source. The first part of Title II is Subtitle A, and it's known as the Relief for Workers Affected by Coronavirus Act. And this act, basically, it extends unemployment for those people who are affected by COVID-19. 2 of the big things that this bill sets up are the Pandemic Unemployment Assistance Program and the Pandemic Emergency Unemployment Compensation Program. Though the benefits are extremely similar, the people that they apply to are very much different. The Pandemic Unemployment Assistance Program is a little more lenient with who it applies to because these people just need a self-certification that they are able to work, but that they are unemployed, partially unemployed, or unable or unavailable to work because of COVID-19. There's a huge list of reasons listed out in the bill, and they vary from having symptoms to caretaking for someone who has symptoms to being diagnosed with, or maybe you were scheduled to work and no longer allowed to come in because of COVID-19. Also, these people need to be either self-employed, partially employed, or not have enough experience to work. Individuals covered under this program are entitled to 39 weeks of these benefits between the dates of January 27th, 2020 and December 31st of 2020. The amount of money that each individual is entitled to for those 39 weeks is dependent upon the state which that individual lives. Each state has a regular compensation amount that is calculated, and this bill states that each individual is entitled to no less than 50% of that amount plus an extra $600 that's laid out in Section 2104. The Pandemic Emergency Unemployment Compensation Program applies to those people who are no longer receiving regular compensation from their employer, but they are available, they are able, and that they are actively seeking work. The amount of money individuals receive under this section is dependent upon the state in which that individual lives. Each state has laws that govern how much compensation and unemployment benefits an individual receives based upon their regular compensation from their job. You'll get that benefit, plus you'll get the federal pandemic unemployment benefit lined out in Section 2104, which is the $600 that I was talking about earlier. Another important provision of this program is that it extends state unemployment benefits by 13 weeks. The extra $600 that I've been talking about for the past 2 programs on top of state unemployment benefits is lined out in Section 2104. There's also fraud clauses in Section 2107, which lined out the Pandemic Emergency Unemployment Compensation Program, and it says that you can face up to 5 years in prison and a fine. An important thing to note about Section 2104 and the extra $600 that you'll receive on top of your unemployment checks from the state benefits is that it's not permanent and it doesn't last for the entirety of the unemployment period. It only lasts from the day that your state opts into the program. Yes, your state has to opt into this program until July 31st. So you'll only receive this extra $600 on a weekly basis until July 31st. Section 2105 of this bill, and a portion that I think doesn't get enough attention in the media, appropriates money so that states can immediately start paying unemployment benefits. Section 2106 of this bill is also an under-highlighted portion of this bill because it allows for states to staff up in order to intake all of these applications that they're going to get for unemployment and process them a little quicker. At this point in the video, we've gone over a lot, and I've said this allows states, this allows this, this allows this. And what I mean by that is that the federal government is paying 100% of that cost so far. So everything that we've talked about, the federal government is going to appropriate money to states to cover 100% of that cost. And that's going to bring us to this week's pivot. This week I'm going to talk about part-time compensation programs. And what part-time compensation programs are is that they allow employers to cut employees' hours without laying them off. So not only is it focused on retaining employees, but if your hours are already being cut, you can claim unemployment benefits to make up some of that income that you're not seeing anymore. From what I could find, there's only 27 states with short-time compensation laws currently in effect. The first part of the bill that deals with short-time compensation states that states who incur costs from short-time compensation, that entire cost will be covered by the federal government. Now, this only applies to dates after the enactment of this act up to December 31st of 2020. And the amount of compensation that can be given to an individual is equal to 26 times the state unemployment benefit. So if you make $400 from your state unemployment benefit, you can only get $10,400. The bill also allows for states that don't have short-time compensation programs to set up agreements between employers and states to come up with a temporary short-time compensation program. However, the federal government is not going to cover 100% of this cost. The federal government's only going to put up 50% of the cost, and the employer has to put up the other 50% of the cost of the unemployment. This next section of the bill that deals with short-time compensation programs is the reason I thought this was so important, and that's that the federal government is not mandating short-time compensation programs. Instead, they're going to give out grants to states that already have them or enact and then promote them during the time period between March 28th and December 31st. That's clearly not enough time for a state to pass and then successfully implement this system. Not to mention, the grants aren't really that big. They're committing $100 million to this portion of the bill, and they're splitting it up between states based upon taxable income in the state. And the top 10 states take up 60% of that income. So they're going to get 60% of that $100 million. That only leaves $40 million for 40 states. Honestly, this is way too little, way too late. Now, it is good that they're going to set up a structure of language for states to hopefully enact these laws really quickly, but not mandating them is such a setup for failure in the future that if something like this were to happen again, we'll just be right back to where we are. And that's unacceptable. So here it is, the big famous $1,200. I'm sure everyone who's watching this video has read something about this, and yes, it's true. Every eligible person is going to get $1,200 back on their tax return and $500 for each eligible dependent that person claims. Now, when I say eligible person, that's any non-resident or illegal alien. Those people are not qualified. Estates and trusts do not qualify, and any dependents do not qualify. So whether you are employed or unemployed, you qualify for this $1,200. Section 2202 sets up some special rules around retirement accounts and allows for distributions to be taken out up to $100,000, as well as loans to be taken out up to $100,000 without any penalties on the distributions. The loan payments are deferred for at least 1 year. Interestingly, the bill treats these distributions as gross income over the next 3 taxable years, so you don't have to pay income tax on all of it upfront in the next taxable year. You can distribute it over 3 years' time. There's a couple sections in this bill that have to do with charitable contributions, and one section allows individuals that don't itemize to claim up to $300 in cash contributions to charitable foundations on their next tax return. For those that do itemize, the amount of gross income that can be claimed as charitable contributions has been raised from 60% all the way up to 100%. So you can claim 100% of your income as charitable contributions on your next tax return. For corporations, the percentage of gross income that can be claimed as charitable contributions has increased from 15% to 25%. Part of this bill also allows employers to pay for student loans tax-free. So it won't count as income to the employee, and the employer won't have to pay any taxes on it. Subtitle C is the business provisions, and it has to do with giving credits to businesses for retaining employees during this time of distress. So this is going to get a little nitty-gritty, and there's a little bit of math that needs to be done to understand this next section, but this next section is about employer taxes and the credit that they receive back on those. So employer taxes are for Social Security and Medicare, and they're paid as a percentage of the gross income for an employee. And it's 7.65% of an employee's gross income is paid by the employer. Now that you know that, the amount of income that an employer is allowed to claim in this next section has a maximum of $10,000. And they can receive 50% of the money that they pay in employer taxes on that $10,000. That means they get 50% of 7.65% of $10,000, or in other words, it's about $382.50 per employee. Businesses can start receiving these benefits if in the first quarter of the year, their gross receipts are 50% less than the gross receipts of the same quarter of the last year. They stop receiving these benefits when the gross receipts in one quarter exceeds 80% of the gross receipts in the previous year. With employers with more than 100 employees, only wages paid to employees during a time that they were not supplying services, that's the employee not supplying services, can be counted towards this benefit. It's important to note that health insurance is also included as gross income to an employee. So an employer can include that in that $10,000 maximum calculation. Not only does this bill give money back to employers on these employer taxes, but it also allows employers to defer those taxes being paid to 2021 and 2022. They're going to be able to defer 50% of these payroll taxes to 2021, and the next 50% can be deferred to 2022. That's going to give them a lot more cash on hand to keep employees employed and keep payroll rolling. The remainder of this bill allows for corporations to take advantage of some tax credits on net operating losses and interest payments and depreciation in order to have more cash on hand to keep their business afloat. As always, make sure to like and subscribe and follow me on Twitter, and thanks for watching.